Well, I think it's time to get going, and hopefully people will continue to join as we start with the initial introductions. My name is Adrian Bertrand. I work across the 6 capitals and Atleha-edu businesses, and it's a very warm welcome to each of you for joining us for this dialogue on the important topic of Regulation 28 and how it relates to infrastructure investing. And I'm joined by my colleagues, Sifaku Matibe, also from 6 Capitals and Atleha-edu, as well as Sean Kinnear. And we're also delighted that these virtual dialogue sessions have been made possible by our funders, which in this instance is the ASISA Foundation and 91 Asset Management. And yeah, we're very grateful for their support and in helping us to host these interactive dialogue. So in terms of just talking to the program, as mentioned, we're very grateful for the funding that we've received from 91 through the ASISA Foundation. And they have been most generous in funding both publications that we've produced. So on the earlier slide, you'll see that publication on Sustainable Investing 2.0, What Part Should South African Retirement Funds Play? 91 through the ASISA Foundation has very generously sponsored a lot of educational content, including publications such as this one, short articles, educational videos, audio recordings, as well as in-person and virtual interactive workshops such as today's session. You've hopefully joined us for last week's workshop where we spoke about retirement funds and the impacts of climate change and some of the actions that retirement fund trustees can take when it comes to addressing climate risk across the retirement fund investment portfolio. Today's topic is on Regulation 28 and infrastructure investing. Our next session will be on the 24th of May in 2 weeks' time. And that's going to be focusing on the theme of impact investing. On the 1st of June, we'll be looking at ESG disclosure standards and frameworks, or ESG being environmental, social, and corporate governance, another word for sustainability. And then the last session on the 8th of June, we'll be looking at the evolution of pension funds. And it's a little bit of a look back at, how the retirement fund industry came into being, its initial purpose, and how things have changed 100 years on since the first pension funds were introduced. You can register for all of these sessions via the link which you would have used to register for today's session, and please do invite your colleagues and industry friends and contacts to consider signing up for these sessions. What we will also be doing is, and this session is already being recorded, we are recording these sessions so that we can share them with our organized labor contacts and comrade database. And that means that for folk who might not have been able to, for whatever reason, join the sessions in person, they'll still be able to access the content when it's shared with them, in terms of a recording and presentation slide. So please do diarize and register for the forthcoming next 3 dialogues in the series, and we do hope that you can make those. So in terms of today's agenda, we'll do a brief round of introductions. It's an opportunity for us to understand our audience and who you are and perhaps why you've decided to join us for today's dialogue session. Sifaku is going to introduce Atleha-edu, our educational platform, which produces educational content for retirement fund trustees, principal officers, and members of funds. And Sifaku will also speak to a lot of the educational content and the types of educational content that we have available. I'm then going to present for a little while on Regulation 28 using 2 of our infographics that we've produced in the last year, and then we'll have an opportunity for question and answers. We will have a few questions that we'll ask of you, both before the start of the session and also at the end of the session, just to see whether or not you've grown in your confidence when it comes to talking about infrastructure and Regulation 28. And we will close at about 11:30 this morning at the latest. So with that, perhaps this is a good opportunity for us to just take a minute or two to introduce ourselves. We'll start as the host team, and then it would be great if our participants wouldn't mind just letting us know who you are, your name, the organization that you represent, and then perhaps share with us, one reason why you have made yourself available to join us for this dialogue group today. What is of specific interest to you around Regulation 28 and infrastructure? And we'll just do a quick round of intros, and hopefully we will still have more folk joining us during the course of the morning. So as mentioned, my name's Adrian. I work across our 6 capitals and alternative prosperity developed Atleha-edu platform. As mentioned, Atleha-edu enjoys financial support from the ASISA Foundation and other funders such as 91. And it's thanks to ASISA, the ASISA Foundation and 91 that we're hosting this series of online dialogues. I head up our education business and spend a lot of time working on Atleha-edu projects. My own background is I've worked extensively in the area of environmental, social, and corporate governance, working for the UN Principles for Responsible Investment for a number of years, in raising awareness around the importance of investors addressing environmental, social, and corporate governance issues across investment portfolios. And then I've also spent 4 years working at the Government Employees Pension Fund, where I helped to set up the GPF's ESG team within their investment team. And I joined the Alternative Prosperity Group to help set up 6 Capitals Advisory, which is the implementing partner to Atleha-edu in the middle of 2017. So I'm excited about being with you today. Let me hand over to Safaku to ask him to introduce himself. Thereafter, Sean will introduce himself. Sean's got a bit of a cold, so hopefully his voice will hold out. Just brief introductions from the hosting team. Thanks, Safaku.
Thank you, Adrian. Good morning, comrades. As Adrian mentioned, I'm Safako Matide, and I work alongside Adrian and Sean, both across 6 capitals and Atleha-edu. So most of you would know me because I'm the one that sort of helps to liaise with you in terms of like getting you guys to attend. You ask me for the data or just for the dates and stuff. So that's kind of what I do. Well, part of what I do. I help with supporting these workshops, sort of setting them up, organizing them and organizing you guys, both the in-person and virtual ones. I also help with generating the content for Atleha-edu. That's sort of some of the stuff that I do or that's relevant to today. So I, alongside Sean, or I think Sean will be, but either way, it doesn't matter. Sean and I will probably be doing the support for today's meeting. So if you have any issues or any difficulties, you can just ask one of us to help you and we will gladly assist. We're very happy to have you here with us. That's all. Sean, you can go next.
Good morning, everybody. First and foremost, thanks for joining. As Adrian mentioned, I do feel a little bit under the weather, but I'm happy to be here with you guys today. So I work for the Alternative Prosperity Group. Part of my role is to assist 6 capitals as well as Atleha-edu in supporting Adrian, Safako, and the rest of the team, and just to basically ensuring things run smoothly as far as possible. So as Safako mentioned, you would know him. He's the front man. He's engaging with you all the time, and I kind of play a role in the background in assisting him on that front in terms of the database, some of the communications that are going out, and that type of thing. I think, apart from a warm welcome and some sense of excitement for today's session, I would just like to encourage and to reiterate what Adrian mentioned. We really are about making the circle bigger, achieving greater impact with these sessions and making them go as far as possible. So please do feel, I invite you to reach out to me, to reach out to Sofaka if you have colleagues, if you have people that would be interested in attending these sessions or receiving our publications and distributions and content. And please do pop me a message, send me an email at any point in time, and I'll be happy to help. And enjoy the session.
Thanks so much, Sean and Safaku, for your introductions, and thanks for your support and hosting of these sessions. We have had a few apologies today, so we don't have as full an audience as we would have liked, but we're grateful for those who've joined. So because we are a smaller group, it does give us the opportunity to just, have folk introduce themselves, and let's understand who you are, the organization that you represent, your role, and perhaps, let us know why you've made yourself available to join today's session. So I'm going to just pick on you and ask you to introduce yourself based on where I'm seeing your name on my screen. And apologies if I don't get your names 100% right, but let's hear from Mohato Mosebo. Mohato, are you able to briefly introduce yourself, please? You should hopefully be able to unmute yourselves and just take a brief moment to introduce yourself. Mohato, are you able to do that? Okay, there's not much of a response from Mohato, so hopefully let's move on, and hopefully we can come back to Mohato. Moses Standar.
Good morning, Adrian.
Yes.
Yes. Good morning, Adrian, and good morning to everyone. Second session that I've joined. I joined last week's session as well. I'm involved with NAPTOSA, National Professional Teachers Association of South Africa. We are affiliated to Fiduciary, the Federation Fiduciary, and my interest in Regulation 28. In education, there's the whole issue of access to pension funds. It is well known that the government wants access to the fund for infrastructure. Teachers want access to funds because of the impact of COVID-19 and the financial difficulties they're going through. So my interest from education perspective is it a good thing, or is the GPF the sole purpose of it for retirement benefits of those who have contributed to the fund? And that is primarily my interest, Adrian. Thank you for the opportunity.
Thank you, Moses. And it's always great to have folk who joined us from one of our earlier sessions rejoining. So that means hopefully that you found benefit in joining us last week for the climate focused theme, retirement funds and climate risk. And Moses, I think you raised good questions around the role of in the South African economy, and what should the GPF investment portfolio be used to achieve. And I'm sure you're not alone in terms of being a teacher and representing public servants. There's a lot of interest around how the GPF assets are used from an economic perspective, but at the end of the day, GPF is there to pay pensions to GPF members. So thanks, Moses. Sabelo Zondo, are you able to introduce yourself, please, Sabelo? I know that in some instances there's often, background noise and things, and you're not always able to speak. So Sabelo, are you able to introduce yourself? Otherwise, we'll move on to one of our other guests.
Adrian, sorry, Sabella's struggling. He's rejoining, so just save him for last.
Thanks. So we'll come back to Sabelo as well as Mahatu. Lena Gianni, are you able to introduce yourself, please, Lena?
Thank you very much, Adrian, and good morning to everyone. I'm Gianni Lina from Dinosa, the nurses. Yeah, I think Moses covered me very well on the very same interest that I had on the infrastructure and the investment. Whether we as public servants are the benefits that we should be getting used correctly for us to benefit, or they benefit the public either than us. Of course, the contestation between all the investment that is there, whether it should be used for the public consumption, to build infrastructure, to do whatever that is not there in the country, or should it really benefit us only? And yeah, I think those are my interests. And the realities, Adrian, are all the factors that are affecting the society. They are affecting us as nurses as well. We are part of the society, though we have a social responsibility towards the communities. Thank you.
Thank you so much, Lena, and also great that you are joining us again. We know that you joined us last week, and great to have Dinosa represented. And again, as you say, discussion around the societal role that perhaps civil servants can have in terms of your retirement fund investments being used not only to achieve investment returns to pay pensions, but at the same time where they can potentially achieve socio-economic impacts through infrastructure investing, for example, that could be considered. So thank you, Lena. Then I have Shirley Kapola. Shirley, are you happy to introduce yourself briefly, please?
Thank you, Adrian. Good morning, everyone. My name is Shirley Kapola. I'm representing Dinosa as well. Yeah, I think Lena has covered me, and more just to learn more about Regulation 28 and infrastructure investments. No, thank you.
Thank you so much, Shirley, and good to have Dinosa well represented here today. Let's try one last time. Mohato, are you able to speak and unmute yourself? Just to briefly introduce yourself, please. Okay, I think we'll move on then. Let me just check. I think we've got everybody, so we'll proceed then with the program. So what I'm going to do is I'm going to ask Safaku to just introduce Atleha-edu. We realize that some of you joined us for our last session, so we won't spend too much time on the overview of Atleha-edu and our educational educational offering and resources that you can make use of. So Safaku, you've got quite a few minutes allocated, but you don't need to use the full 15 minutes. And again, these are great resources on themes like infrastructure and Regulation 28. And I'll actually be using some of the educational content that we've developed previously for today's discussion. So we'll spend some time looking at the infographics, which will help explain Reg 28 and infrastructure. Thanks, Safaku.
Thank you, Adrian. Do you mind unsharing? Thanks. Hi, everyone, once again. So my job today is, or other than the support, is also just to sort of give you guys an overview of some of the Atleha-edu content, or of the Atleha-edu platform itself. As Adrian mentioned, we already did a bit of an overview of Atleha last week, and most of you were there already. So I'm not going to spend too much time sort of explaining what Atleha is, because I think by now you're familiar with it. But I just want to sort of highlight the fact that, you know, it's very important for us sort of with this platform is to create content that is sort of user-friendly and that will sort of explain subject matter related to the retirement fund industry that is, you know, a lot more understandable, a lot easier to sort of digest. We wanted to be, you know, as accessible to everyone or all the stakeholders in the retirement fund industry, whether they are educated or are sort of advanced in terms of all the terms that exist, or if they're just people who are trying to figure out what sort of to expect or how they can, you know, be more active in securing their pensions one day. So I'm just going to, because I'm going to show you the website again, because I remember last week we kind of had to do it in a rush. So hopefully today we might sort of spend some time with me showing you what the site actually looks like. Can somebody confirm that they can see my screen?
Not yet.
No. Hold on, let me try again. How about now?
Yes, Safaga, I can see your screen.
Great. So this is the site. So it's atleha-edu.org. And if you type that in, it'll lead you to this sort of landing page, which is our home page. So we will usually put the latest. So how Atleha, or the types of content that we generate, is fourfold. So we have education publications, which we make, which is usually like 16 to 20, depending on how much content we have, 16 to 20 pages on a specific theme or a specific topic. Then we use that publication to sort of generate a whole number of other things. So that can be short articles on certain sort of subjects or subtopics within the publications, as well as infographics, which we make to sort of make some of the concepts more, you know, to illustrate them graphically. So the short articles, also a nice feature about those is that we sometimes have them in different languages. I'll show you now. Then we also create video bits. So some of the concepts or some of the content from the publications we turn into short little 2 to 3 minute animated videos, just to sort of further expand. And, you know, because some people are obviously visual learners as opposed to sort of having to read. So we try to cover all those bases. We also have sound bits, which would usually be short articles which are read aloud for your convenience. Some are also read in different languages, but I'll show that to you as well. Excuse me. So how the page or how the website usually is set up is, if you open the landing page, you will find the latest publication that we released. So the latest we had, or we have, is the Sustainable Investing 2.01, which is funded by, or co-founded by 91 and the Asisa Foundation, who are also funding these virtual workshops. But I think one of the, like, if you want to access the other publications, there's a tab here, the Trustee Education tab. You can just click on Education Publications and it will lead you to our archive. So we currently have 12 publications that we've sort of published since 2020. Okay, well, the first 4 are from years back, but we rebranded them. So these are the first, we've had these out since 2020. And like I mentioned, it's a whole bunch of different topics. We have one on governance and ethics. We have some investment fundamentals ones. We have one which we're kind of proud of, which focuses on sort of cultural practices and how the cultural practices in South Africa affect sort of retirement fund outcomes for members. We have one on sort of retirement funds and risk management. So there's a whole range of different topics. We have some climate related financial disclosure ones, as well as environmental stewardship ones. So we sort of try to cover basically everything within the ESG landscape. And it's actually really good content. There's quite a few sort of interesting articles for you to read. So I encourage you to take some time to visit the site if you're bored, or if you want to reflect on some of the stuff that we discuss in these sessions, because most of the time there is a publication for it, or if there isn't, there is a short article for it, or there is a video bit for it. I think a publication that is of interest for today's topic, though, would be the Introduction to Infrastructure Investments. So if you see, this is sort of the landing page that you will get on for any of these publications. So if you click on read more, it will lead you to a similar page like this. So you can sort of read an interactive version of the publication, which is just it's just a sort of fancy way of reading. So it sort of allows you to flip the pages. It just makes the reading experience a little more interesting. But if not, you can always just sort of download. So you can download the publication for yourself, and then, you know, to read offline, also to share with other people that you think might benefit. And then the nice thing also is you're also able to give us sort of your feedback on each. So each of our content pieces, whether it's publications, whether it's videos, whether it's sound bits, they each have a sort of section where you can just give us your opinions on sort of your experience reading or consuming the content, because we obviously, we're sort of on a continuous process of improving and making the content as easy or as accessible or as understandable as we possibly can. So your feedback obviously is very valuable to us, because, you know, we actually use that for future iterations of our content to just make it, you know, we want to put as much, or to have you guys derive as much value from this content as we can. So, you know, after reading a publication or whatever, please be sure to sort of complete this perceived value survey. We actually use it, so don't think that it sort of disappears into the void. We do use them. But then also for your own sort of development, if you are sort of a delegate or whatever that who subscribes to the Bateta CPD system, the nice thing about our publications is at the end of each publication, you can complete a quiz wherein you will get CPD hours, which you can then claim from Bateta. So I think that's just a nice little value add for you as well. Yeah, I don't want to spend too much time, but I just want to show you some of the short articles also that are, so this trustee education tab, it'll give you, you know, if you're looking for a specific type of content, you can just click on it and it'll lead you to a similar sort of archive like this. So there are, if I'm not mistaken, 6 infrastructure investment short articles. Yes. So it starts here, one with an introduction to infrastructure investment. We have one on long-term investing in infrastructure, prescribed assets, and yeah, understanding the different types of infrastructure investment. And then there's one also to help you find more resources related to the infrastructure investments topic. So you can also read these. These are basically just summaries of articles that are in the publication, but some obviously go a little further in depth. Yeah, and they also have, they also provide space for you to just give your, you know, the value that you've derived from the article. Yeah, that's basically all. There's obviously a lot more. If you want to find out more about Atleha or how you can use it for yourself, or how you can also get other people to register or to sign up to receive the content, because I think most of you do receive an email every Friday. If not, you can also let me know. But there's also like a little section where you can sort of fill in. But if you need more information on that, you can sort of speak to me. Yeah. Thank you, Adrian. I'll hand back to you. Unless anyone has questions.
Thanks, Safaku. And yes, we're a smaller group today, so that does give us the opportunity for more questions and interaction. So please do feel free to raise your hand. If you've got a question or a comment, you can also use the chat function. You know, we've got an hour and a half together. Let's make the most of it and try for that to be as interactive as possible. Sabelo, it's great that you're back. We know that you were having some challenges. Do you want to take a minute just to quickly introduce yourself again and your interest in today's workshop? Sorry, Sabelo, you're still on mute. Are you able to unmute yourself?
Can you hear me now?
We can hear and see you.
Thank you very much. My name is Sabelo Zondo. I'm a Bekau short steward and also a director of Ilenge Holdings and also Ilenge Foundation. I'm a concerned citizen of the world and also of South Africa and the CADA about our infrastructure and also to develop our society at large. And I would like to have an organization or anything that will provide for the future of the society, because I believe our conversation or our meeting today is also concentrating in the future, because we talk about the investments, also the pension fund, of which I think is a background and of the future of our society. Thank you.
Thank you for that introduction, Sabelo. And we know that you're joining us again for the second session. You joined us last week, so great to have you. And yeah, we echo your sentiments around the importance of infrastructure for a healthy and a growing South Africa, South Africa's economy, South African society. So it really is great to have you with us this morning. I see we have another individual joining us, Paulette, but we'll give her a bit of time just to settle before we ask her to introduce herself. But what we would like to now do is just run 3 polling questions. So there's going to be something that will pop up on your screen, and they're going to be 3 questions related to the content that we'll be covering today. So hopefully Sean is able to load those polling questions, which you should see on your screen. So I'm going to just read the question. It's a confidence question, and what we'll do at the end of today's session is we're going to ask you to complete the same questions again, and we'll see if there's been some improvement in your level of confidence in being able to talk about the topic of Regulation 28 and infrastructure. So the first question is, how confident are you about talking about infrastructure investments? Are you not confident at all? Are you not very confident? Are you confident or very confident? So take an honest assessment of how confident you feel about, you know, what is your knowledge of infrastructure investing? Would you be able to be confident having a conversation about that? So if you can respond to that, that would be super. Looks like it's a bit of a you know, evenly split between some of you being very confident, some being confident and not very confident. We are just wanting a few more people to participate if you can. let's give you 1.5 minutes to respond, and then we'll move on to the next question. Okay, Sean, you can, and thanks, Lena, for the comment in the chat function. That's another way. That's another way to respond. But ideally, if you can via the online survey, please do so. So in terms of the responses, most 50% have said not very confident, and 25% have said confident or very confident. I'm going to end the poll, the first one, and share the results. Hopefully you can see the results for yourselves. 50% being not very confident, with the remainder split between being confident or very confident. Then we're going to share the second poll, and let's see if we can get to the next one. Okay, I'm launching the question. So the question is, are you aware that Regulation 28 is in the process of being updated or revised? Yes or no? So it's a knowledge question. You can take a gamble. It might be a bit self-explanatory as well, why it's a topic for conversation today. So the question is, are you aware that Regulation 28 is in the process of being updated? Yes or no? Please, would you either answer yes or no? Okay, I think we've had good participation, so I'm going to end the poll there, and I'm going to share the results. Okay, so most of you said that you're not actually aware that Regulation 28 is in the process of being updated, with 20% of you saying that yes, you were aware that Regulation 28 is currently under formal review and being updated. And then the last question that I will put up is, how confident are you talking about infrastructure investments? So are you not confident at all? Are you not very confident? Are you confident or very confident on the topic or theme of talking about infrastructure investing? You can take a few seconds just to respond to that poll. Okay, if we could just have a few more people responding, that would be great. But at the moment, what I'm seeing is that most folk are not very confident when it comes to talking about infrastructure investing, presumably why you've joined today's session, with the remainder being split between being confident or very confident. Okay, I'm going to end the poll, and I'll share the results. So here you can see that most folk are not very confident, 50% not very confident, with the remainder being either confident or very confident. Okay, well, thank you so much for participating in those polls. Let me just share my screen again. Okay. Can you, yeah, you should be able to see my screen, which has got the agenda on. So hopefully you're seeing that, and thanks for participating in the polling questions. And we're going to repeat those questions at the end of the session to see if we can improve on those numbers. Okay, Paulette Marman, I see, Paulette, you've joined us in the last couple of minutes. What we've done is we've done a brief round of introductions for our attendees, and we've really just asked attendees to very briefly say who they are, who are you representing, and what's your specific interest in the topic under discussion today. If you're comfortable and willing to introduce yourself, would you be happy to do so now, please, Paulette? I know it is putting you a little bit on the spot. Okay, I'm not getting a response from Paulette, so we'll move on then, and hopefully we can get to know her a bit later. Okay, we've already heard from Safaku around the overview of Atleha-edu and our various educational content that you can access via the website. And we're grateful to 91 and the Assisa Foundation for the additional funding that they've provided for our current project that's underway. And so this is where we really have the opportunity now to get into the discussion around Regulation 28 and infrastructure. And I'm going to be using a few infographics to speak to that. So let me just load the infographic that I'm wanting to spend some time on in terms of the first infographic. Okay, I was able to screen share and I seem to have lost that functionality. Safaku or Sean, are you able to help me with that?
Hi, Adrian. I've set you up now. Try again.
Thanks. Okay, perfect. I've got it now. Okay, so hopefully you can all see the infographic. I know some of the writing will be a bit small, but we won't go into the kind of very small detail, but we'll also in the chat function, we'll share the link to this specific infographic. But this is an overview of the asset classes that Regulation 28 speaks to. So just about Regulation 28, so it's part of the Pension Funds Act. National Treasury is the custodian or the owner of Regulation 28. And Regulation 28 really provides to retirement funds the guidelines around how retirement funds are allowed to invest in South Africa. And it speaks to how South African retirement funds can invest, both in terms of their South African, but also their international investments. So Regulation 28 gets updated every so often. And effectively what it is there to do is to help protect the investments of South African retirement funds from potentially maybe making investments where you're not sufficiently diversified across different types of investments. So imagine if your whole retirement fund was invested in Steinhoff and then Steinhoff goes bankrupt, or African Bank, or some of these other examples. The fact that Regulation 28 says that you have to have exposure to so many different types of asset classes is a way to reduce risk. So we all know the saying, don't have all of your eggs in one basket. What Regulation 28 is trying to achieve is to help retirement funds diversify your investment portfolio so that you don't have all of your investment eggs in one basket, but that you've got your investment risk spread across different asset classes. So the asset classes that are provided for, or the investment types that are provided for in Regulation 28 are equity, which are shares in companies, cash, debt instruments, which are loans that are made to companies or institutions, property or real estate, commodities such as oil or grain stocks or gold, metal commodities, and then alternative investments, which include private equity, hedge funds, and other alternative type investments. And what Regulation 28 does is it gives the upper limits or the maximum amount of exposure that you can have as a retirement fund investor to any one of these types of asset classes or investment categories. So you'll see that the percentages are given there. This is on the previous Regulation 28, so before it was updated. But your equity exposure, the maximum amount of the retirement fund investment portfolio that you are allowed to invest in shares of companies, and specifically listed shares, is 75%. In terms of cash, you could invest up to 100% of the investment portfolio of the retirement fund into cash or deposits held with a bank. When it comes to debt type investments like bonds or loans that are provided to companies or entities, you could have up to 100%, so also quite a high allocation. You could have as much as 100% invested in debt type or fixed income type investments. Property, you are limited to only 25% of the retirement fund's investment portfolio into property. For commodities, it's only 10%, and for alternative investments, it is 15%. Now, part of the reason for these restrictions is because of liquidity. So some types of investments or asset classes are more or less liquid than others. What does that mean? So when an investment is liquid or illiquid, a liquid investment is an investment that you can turn into cash that you can then use to pay a pension quite quickly. So listed equity is very liquid. It's very easy to sell and to trade and to get out of your investment, and to get out of your investment by getting cash in return for selling your share. So listed equity is very liquid. Obviously, cash itself is liquid. Some forms of debt investments are more liquid. And that's why the allocation is higher in terms of the Regulation 28 upper limits that are provided for. Property or real estate, we all know in terms of the houses that we live in, if you own your own home, it's very difficult to sell your home quickly. You can't sell it overnight, especially if you want to get the proper value of your home. And so property is less liquid unless it's a listed real estate investment trust or REIT. Unless the property is listed, it might be an unlisted investment, and so it will be less liquid. And so that's why property has been restricted to 25% of the total investment portfolio for a retirement fund. Commodities, some people might say, go and invest all of your money in gold. Gold is not always liquid, as is the case with other commodities, and they can also fluctuate in terms of their value. And then, of course, alternative investments like private equity or hedge funds. Hedge funds might be quite liquid, but they're higher risk in some instances. Private equity, generally, you are committed to about a 10 to 15-year period. So it's less easy to get your investments out of some of these more illiquid asset classes. There are also different limits in terms of subclasses within each asset class. And there are limits to those various subclasses. For the purposes of today's session, we're not going to go into all of the details around Regulation 28, except to comment that the main changes in terms of what is being updated currently by National Treasury to Regulation 28 is the exposure limit for South African retirement funds to invest outside of South Africa. So the previous limits was 30%. You could invest up to 30% of your retirement fund outside of South Africa. That has now been extended to 45%. So you could move 45% of your retirement fund's investment portfolio to invest in opportunities outside of South Africa, so in the rest of Africa or the rest of the world. There is also a 10% allocation to the rest of Africa. So you can also invest an additional 10% in the rest of Africa. And this is a move by the regulator or by government to allow retirement funds to diversify outside of the South African economy. And there's a few reasons for this. Obviously, diversification is a good thing. We are also seeing that our universe of listed equity investments via the Johannesburg Stock Exchange is shrinking. Some companies are choosing to delist from the stock exchange, and they are becoming private companies, which you could invest in privately as a retirement fund investor. But again, it would be less liquid than listed equity investments. One of the other reasons is that we have some very large shares in South Africa listed on the Johannesburg Stock Exchange. So if you own Naspers or process shares, you have a concentration risk around a particular company or sector. And the intention of Regulation 28 of the Pension Funds Act is to always help to diversify risk. And so most fund managers in South Africa will offer what is called a balanced portfolio or a balanced fund, where what they do is they will take a selection of these different asset classes and put them together into an investment fund for their retirement fund clients, which helps to reduce risk. So that's one of the main kind of changes that the update or the proposed update to Regulation 28 brings into play. That being, there's a greater exposure that is now allowed for South African retirement funds to invest more of their investments in the rest of the world, including Africa. And that's 45% of the entire investment portfolio can be invested outside of South Africa. Also, on the 45% number, that is a change that is around the opportunity for South African retirement funds to invest in infrastructure investments. So previously, infrastructure investments weren't really specified in Regulation 28. And what the revision to Regulation 28 now allows for is for up to 45% of an investment portfolio of a retirement fund to be invested in infrastructure assets. And we're going to explain infrastructure assets with the next infographic, with a restriction up to 25% of the entire pension portfolio can be invested in an infrastructure instrument or infrastructure issuer. It has to be limited to 25% to either a particular infrastructure player or presumably also an infrastructure theme. So what the revision to Regulation 28 is doing is it's encouraging South African retirement funds to allocate more of, or it's an opportunity to allocate more of their investments into infrastructure assets. Now, infrastructure assets are generally speaking good investments for retirement funds because, as you know, infrastructure projects for the most part have got very long lifespans. In many instances, infrastructure projects have got some elements of almost a little bit of a monopoly. So if you think about a toll road that's going to be there with a concession for 30 or 40 years, for 30 or 40 years, that toll road is going to be receiving income. It's going to be amended over a period in terms of inflation. And so infrastructure investments are fairly good about keeping pace with inflation. And inflation is a risk for retirement funds because, of course, you want to be paying inflation-linked benefits to your retirement fund members at the time of retirement and beyond into their retirement years. So infrastructure is one of the other big developments that has come through in the revision to Regulation 28, where retirement funds in South Africa can now invest up to 45% in infrastructure type investments across different asset classes. That's also quite an important point to note. So you can hold an infrastructure asset either in terms of your listed equity portfolio or a private equity portfolio. It could also be via a debt or a fixed income investment. It could be an alternative investment, and infrastructure as a theme has often been included under the alternative investments category. And those infrastructure investments can also be made domestically in South Africa or in the rest of Africa or in the rest of the world. And what the updated Regulation 28 has also done is it's served to redefine what qualifies as an infrastructure investment. So in their classification of infrastructure, that these investments are there to perform a social service or a social good. It allows for both public-private partnership type infrastructure projects, for example, like a Gautrain, or our renewable energy REAP program projects around solar projects or wind projects, etc. But investing in Eskom as well, investing in Sunroll or state-owned entities in terms of some of their programs, that's allowable, as is investing in private sector-driven infrastructure projects. And of course, we also know the social and the economic benefits of investing in infrastructure. Infrastructure requires people to work. It puts people to work. So from a job creation and an employment creation opportunity, infrastructure can also be very useful. So this is a very kind of brief overview of Regulation 28 and the updates to Regulation 28. We are waiting on the South African government to promulgate the new Reg 28 document. What we have heard from National Treasury in the February budget speech has been where Treasury is going with the updates to Regulation 28. We are waiting for the updated policy document to be promulgated or printed, and that is imminent. And once that has been done, we will update the asset classes per Regulation 28 infographic that you can see on the screen now, and we will probably also be running similar sessions on the final version. But for the purposes of today, we wanted to show you the direction of travel and how Regulation 28 is currently being proposed for change. Maybe one last comment on Regulation 28 before we move on to the infrastructure infographic is that Regulation 28, when it was last updated back in 2011, introduced the requirement that retirement fund boards of trustees need to consider sustainability factors or environmental, social, and corporate governance issues when they consider their investment allocation according to these different asset classes. So already for more than a decade, we've had a requirement that trustees of retirement funds need to consider the long-term sustainability of the investments that they are making on behalf of their members of the fund. And they need to do that by considering ESG issues, sustainability issues, issues like transformation when it comes to making investments. And that is included as a principle, as some principles within the regulation itself, as well as in the preamble to the regulation. And so when it comes to these changes and any updates to investment policy statements for retirement funds, as well as rebalancing investment portfolios based on these changes that National Treasury is proposing, it's also an opportunity for retirement fund boards of trustees to reconsider how they are considering formally in their investment process matters of transformation, ESG, sustainability, etc. I'm going to stop there, and I'm going to then share the second infographic, which is going to be on infrastructure types. And we will be going into some time for Q&A in the next few minutes. So if you've got questions, you're welcome to start writing them in the chat function. But you can also note them, and we will have an opportunity to discuss those questions in the next few minutes. Okay, I'm sharing my next infographic. And again, we'll share the links to these before we close today so that you'll be able to download these PDFs for yourself and to share them with colleagues. And yeah, again, these are here just to help with an overview understanding of the theme. And in this instance, it's trying to understand different types of infrastructure. So what Regulation 28 allows for is you can allocate up to 45% of your investment portfolio into infrastructure assets. Well, the question then is, well, what do these assets or what do these investments look like? And what are the different types of infrastructure that are available to investors? And so what this infographic seeks to do is split out infrastructure investment across different themes or approaches. So there are examples of economic infrastructure examples, social infrastructure examples, and environmental or green infrastructure examples. And again, as there's more and more of a focus on the infrastructure theme or asset class, there will probably be more guidance on this from the industry and from government and regulators. But if you think about economic infrastructure, that infrastructure which is supporting the economy of South Africa, examples of that could be electricity provision, and we know the challenges that we're sitting with Eskom and load shedding. Being able to have a reliable source of cost-effective power for South Africa is critically important for our economic and social well-being as a country. Think about commuter transport, roads, railways, airports, harbor ports. Getting workers to their places of employment is critically important, and there's different examples within transport where retirement funds may wish to invest. One can also think about ICT and broadband infrastructure, the importance of telecommunications, whether that's 5G mobile network towers or fiber for internet, for your workplace, or being able to work from home, as I'm doing today because of having access to high-speed internet, water infrastructure and related services. Again, we mentioned this last week, but the events, the devastating floods in KZN Natal, there is billions to be spent on fixing and refurbishing and replacing KZN's water infrastructure and related services as a result of the floods. Government can spend, as much as it can on, those needs, but it will also need the private sector to come alongside and to invest for a financial return in these types of infrastructure projects. Liquid fuel infrastructure. I flew through Johannesburg yesterday. I was in Johannesburg for the last 2 days, flew back to Cape Town. There is supposedly an aircraft fuel shortage at OR Tambo in Johannesburg because of pipeline issues between Durban and Johannesburg. So, it's amazing how, one natural disaster in one province has knock-on social and economic impacts in other provinces, not to mention the devastating social and economic impacts on the KZN provincial economy. So those are examples of hard economic infrastructure assets which support our economy, but again, there are also, of course, socio-economic benefits to those types of assets as well. If we think about social infrastructure, this is where our DENOSA and our NAPTOSA colleagues come in. Education, healthcare, affordable housing, making sure that people have got a roof over their heads, that when they get sick, there is medical support and treatment available. Education, how do we train the next generation of youth to be able to be employed and to contribute actively to our economy? And then, of course, things like broad-based Black economic empowerment, the Black Industrialist Program, development of SMEs, enterprise development, job creation. There are also opportunities through social infrastructure type projects to help deliver on job creation targets, etc., and transformation targets. So it's all very well if we have all the hard economic infrastructure assets in place, but if we don't have the human capital, if we don't have a healthy, workforce that is able to make use of those infrastructure assets and to turn those assets into services and products for the market, our economy is not going to thrive as it can and should. And then lastly, with the pressing need to address climate risk, to be able to transition from a carbon-intensive economy to a cleaner, greener, more efficient economy, certainly from a power perspective, there's an opportunity in energy projects, waste, water, agriculture, real estate and infrastructure, and then of course also sustainability and green bonds. So again, across all of these examples in the infographic, there are a number of different types or categories of investment that one can also explore. So infrastructure is very broad, and that's why I think National Treasury is comfortable to give retirement funds the go-ahead to invest up to 45% of their portfolio in infrastructure type assets, because you can still have that diversification across asset classes, across asset types with different risk and liability profiles, different return profiles, and you are not putting all of your eggs in one basket, even though your allocation to the infrastructure theme might be quite high at 45%, should you decide to go to that upper limit. But again, remember that that can also be in terms of your investments made in South Africa, the rest of Africa, and indeed in the rest of the world. So, I'm keeping an eye on the clock, and I do want to allow some good time for Q&A. So I think let me stop there in terms of infrastructure types, maybe just to mention again that, infrastructure can be seen as an appropriate investment theme or asset class or subcategory for retirement funds because of the long-term time horizon that infrastructure type projects cater for. Infrastructure projects, generally speaking, are contracted for extended periods of time. As mentioned, different infrastructure projects in many instances do have monopolistic type features where you would have a concession, whether it's an ESCOM or a SUNRAL around building roads or toll roads. You're able to, in a sense, de-risk and lock in those inflation-linked returns for an extended period. Increasingly, there is also a second market for infrastructure type projects. So some of the early investors into the first renewable energy program, the REAP program, which goes back probably close to 10 years, some of those early investors have already been able to sell out of that investment and to sell those investments to new investors. And so what is also now increasingly possible is that you can invest in an infrastructure asset without being tied in for such extended periods of time. And the more in South African retirement funds investing into retirement fund assets, the more those investments will be able to be kind of syndicated, spread across more investors, and there should be more liquidity. And again, that will be informed by the type of exposure that you are going to have, whether it's as a listed equity investment or a privately held investment or a debt investment, and those will have different risk return and time horizon implications. For those of you interested in the infrastructure theme and learning more about it, the ASISA Academy offers a one-day workshop on infrastructure. It's available at no cost to South African Retirement Fund trustees, and we'll share the link to the Academy's infrastructure workshop brochure, so you're welcome to learn more about that and to attend that at no cost, and they run virtually much like today's session. The other thing to mention is that BATSETA, the Council for Retirement Funds for South Africa, has introduced a new project focusing on infrastructure investing, and it is bringing South African retirement funds together to see how retirement funds can work together to address some of the challenges to investing in infrastructure. It's there to help with capacity building, and they've got funding from the World Bank and the likes of the Development Bank of South Africa and others are involved there. And you're welcome to also have a look at the link that we'll include in the chat function around Batseta's Asset Owner Forum, which is focusing on infrastructure investing specifically. Okay, so with that, I've done enough talking, I think. I'm going to have a look at the chat function to see if there's any chats or questions that have come up. I'm seeing that Safaku's kindly shared the 2 infographics. So there's no questions that have come up. So yeah, is there anybody that would like to raise their hand and make a question or ask a specific comment as we now go into the Q&A time for today's session? Moses, I see your hand is up, so you've got the floor. Please go.
Thank you, Adrian. The first question I want to ask, the Board of Trustees of a retirement fund, in the case of education, in the case of the GPF, the Board of Trustees, the fiduciary function of those trustees, if there's an investment that has not yielded the anticipated results, are those trustees then held accountable? The second question, the PIC, the investment arm of the GPF, has a history that is not, how can I term it? You had certain CEOs that there was some controversy around the way that investments took place. And that has not, it hasn't had the result of inspiring confidence in public servants who contribute to the GPF. So I just want to stop there. In terms of those 2 issues, the fiduciary function of the Board of Trustees and your opinion and your colleagues' opinion in terms of what the PIC, the way they have invested so far. What is your opinion in terms of those 2 issues? I want to come to the issue of the different types of infrastructure later. Because if you talk to educators and you say to them, look, the government want access to the pension fund, if they hear anything about investment in ESCO or PRASA or healthcare, if I can only refer to the NHI, Adrian, there is no confidence at all. But I want the issue of the infrastructure types I want to touch on later if we have the time. My first 2 questions only pertains to the PIC and the confidence or no confidence they have inspired so far, and the fiduciary function of the Board of Trustees of the pension fund, if that is okay with you.
Thanks very much, Moses, for those questions. Sorry, I was struggling to unmute myself, and I think I muted you and then unmuted you by accident. So great questions, all 3 of them, and I'll try and focus on the first 2. So the fiduciary duty or responsibility of a Board of Trustees when it comes to investment performance. So I think we would all like to hold our trustees personally accountable for each and every time investments don't work out as planned. However, investment is a game of risk and return, and nobody has, 100% ability to get things right all of the time. And so we do need to acknowledge that investments generally are always a risky game because we don't have all knowledge. and there will always be different views on the likely investment performance of any type of investment. And so that's why, just in the case of a share, there will be people selling Sasol at the same time as people buying Sasol shares, because we have different views on the future and how Sasol, as just one example of a share price, may change for the better or for the worse going forward. So what the regulator requires of trustees in terms of their fiduciary duty, and it was mentioned earlier today, is, and in terms of Regulation 28, trustees need to consider any and all factors that can materially impact on the long-term sustainable performance of the investments that they are making on behalf of their members. So as long as they are able to demonstrate that they have taken due care and consideration, and in actual fact have demonstrated that they are more careful and more cautious when making investments on behalf of their members and beneficiaries than in terms of their own affairs, then they're on fairly safe ground. Of course, there needs to be proper governance processes, oversight, and in most instances what happens is the pension fund will decide on the investment policy. They will decide on how you are going to allocate your investments across different types of asset classes to be compliant with Regulation 28. And an asset consultant or an actuarial consultant will be helping the board in that respect. You then provide mandates to fund managers, or you purchase insurance products, or you invest into funds via other third parties who you will do a due diligence on to make sure that they are who they say they are, and that they've got the ability to deliver on those promises that they've made to you when you've been kind of contracting with them. That is then outsourced by the Retirement Fund Board of Trustees to those service providers. And that's, in a sense, the benefit of having multiple competing service providers in an industry, is that where for a period of time, perhaps over a number of years, you're seeing that one service provider is significantly underperforming against other service providers, there's the opportunity to terminate those mandates or to move your assets or investment from one fund manager to another. Now, up until now, I don't think there have been legal challenges to a board of trustees and trying to hold a board of trustees personally liable for investments that have not produced the returns that have been expected. And GPF, for example, because they are such a big investor, because of the size of their investment portfolio, unfortunately is generally always invested in, the entire economy. And so they will have had exposure to Steinhoff and African Bank and VBS Mutual Bank. That is unfortunately par for the course with an investor the size of the GPF. So I think for a board of trustees, they need to demonstrate that they are paying, full attention to governance, their own governance, the governance of the service providers that they appoint, that there is monitoring and oversight. Trustees are able to get expert opinion and should be having expert inputs into their monitoring and oversight of fund managers and service providers. And that's why you have asset consultants and actuarial consultants, pension lawyers, and other advisors. And the other thing to mention is that, maybe now moving closer to the GPF example, is GPF trustees, 50% or more of the GPF Board of Trustees comprises organized labor representatives. So labor is represented on the GPF board and significantly represented on the GPF board. So those labor appointed trustees serving on the GPF board are there in a sense to represent your interests, but of course from a good governance perspective, they are actually there to, and their first responsibility is to GEPF. Their fiduciary duty is to the GEPF itself, and making sure that the GEPF itself is sustainable and can honor its promises to GEPF members and pensioners. On the PIC, Moses, the PIC has come under fire, rightfully so, I think, around non-performance of certain investments. A lot of those investments are under the PIC's Isibaya portfolio, which is a mostly private equity or unlisted investment portfolio. There's also a developmental mandate or angle to those investments. So they need to achieve transformation targets. They need to achieve job creation targets. They need to achieve certain socioeconomic targets over and above a minimum financial return. And generally speaking, where investments are not public, there is less information available in the public domain. That can sometimes lead to perceptions of wrongdoing or corruption, just because it's not, you cannot compare on a like-for-like basis a listed equity investment versus a privately held investment, because the privately held investment doesn't have the same requirements to be as public in terms of their public reporting and disclosure. I think the Zondo Commission and the PIC, inquiry has made certain recommendations in terms of governance process improvements that the PIC needs to take on board. The PIC, on behalf of GEPF and the Unemployment Insurance Fund and other clients, I think does have some accounting to do. And I was reading in the paper the other day that the GEPF has renewed the PIC's mandate for the Isibaya portfolio, presumably with some stricter controls and maybe more reporting on the part of the PIC to the GEPF as the client. But yeah, we need to, and the GEPF needs to learn from this, the PIC needs to learn from this. And I think also from a regulatory perspective, maybe the regulator needs to be a little bit more active in terms of monitoring on those areas where perhaps there's been shortcomings. So I think, Moses, the last comment on the first two questions is that, especially when it comes to prescription of assets. So in the apartheid days, the National Party prescribed where investors, retirement funds, had to make their investments. We don't have prescription in South Africa. We have avoided prescription around infrastructure investing by government saying, let's first try and see if we can open up the opportunity for retirement funds to invest in infrastructure, so that we don't need to prescribe that funds have to invest in infrastructure. So there's a lot of freedom for retirement funds to invest in infrastructure assets. So for teachers and nurses, it probably makes sense to try and see if we can get more allocation to healthcare infrastructure, education infrastructure, to benefit your own working environment and work prospects during your active economic life, and not just at the time of retirement. And that can be through both public and private type investment vehicles. Your comment, Moses, around exposure to Eskom and exposure to Sunroll. The reality is that those state-owned entities offer very good investment, especially on the fixed income or the debt investing asset class. Many of those bonds that they issue are government guaranteed or quasi-government guaranteed. They are also inflation linked. So when I worked at the GEPF, and this was at the time of the whole furor around the e-tolling, GEPF was the biggest investor in Sunroll bonds. And those Sunroll bonds were allocated to Sunroll across all of Sunroll's infrastructure projects, not just for e-tolls, for example. The same with Eskom bonds. GPF is one of the biggest investors in Eskom bonds. It's attractive to the GPF because of the long-term, time horizons that are allowed for in those bond agreements. They can be inflation-linked, they can be government guaranteed. And so whether our civil servant members of GPF like it or not, GPF has been and is likely to continue to be a big investor in these types of infrastructure assets through some of these state-owned entities. And that's why it's so important that we as the private sector, through our retirement funds, as labor, need to hold government, SOEs accountable through our retirement fund investment processes and other kind of lobbying processes to make sure that we do achieve the ultimate objectives at the end of the day. Sorry, that was a long response, Moses, but it was quite a detailed question. So I hope that helps.
Thank you, Adrian. And you've also touched on the other questions about the infrastructure types. So, and I see it's already past 11:30. So thank you. But I'll definitely try to enroll for that one-day course you mentioned on infrastructure.
Thank you, Moses.
Thank you.
And that will give a lot more time for discussion and debate as well. For today's session, we're really just touching the surface. It's a high-level overview. Can I ask if there's any other questions or comments anybody would like to make? I'm going to have a quick look at the chat function, but no further questions or comments in the chat function as yet. So if anybody else would like to, raise a question, please do. But I'm going to, as we start to wrap up, I'm going to load the polls again, just so that we can get those responses. Because it would be nice to be able to share with everybody, how you've hopefully gained some confidence as a result of today's session. So I'm going to launch the first question again, and that was around the Regulation 28 update and whether or not you were aware of that update. If you could take a few seconds just to respond to that poll. You should see it on your screen. Are you aware that Regulation 28 is in the process of being updated? Thanks to those who are completing the poll. Okay, so that's well responded to, with everybody now, comfortable that it is indeed being updated, and we're waiting on government for the final version. Then I'm going to load the second one, which is again your confidence questions around Regulation 28. How confident are you about talking about Regulation 28? Hopefully you found today's discussions useful and you've got the broader picture and direction of travel in terms of Reg 28. It is the Bible for retirement fund trustees when it comes to where you invest, the 10 commandments for where to invest. Again, from an investment limit and asset class perspective. But at this point in time, it doesn't say thou shalt invest in Eskom or thou shalt not invest in Eskom. The decision of where to invest in the ultimate investments is still very much the prerogative of the trustees and the fund managers that you allocate your investments to. So good to see that on the confidence question for Reg 28, everybody is either confident or very confident. And then the last question, which will be a, sorry, have we done the 3 questions now? Let's do, yeah, I think we've addressed my 3 questions. I'm going to move on then to our monitoring and evaluation question, just for your feedback on your experience of today's session. Sorry, we do tend to run out of time on these virtual dialogues. So please, would you rate the quality of the educational content provided in today's dialogue? Poor, fair, good, or very good? And then what was your level of understanding? Sorry, we should have updated that. It currently says on climate change, we actually mean infrastructure. So no knowledge, basic understanding, fair understanding, or good understanding of Reg 28 and infrastructure, as opposed to climate change before the dialogue. The next question 3 is about after the dialogue. So do you feel like you've had an improvement in understanding? And then again, in terms of question 4, would you like future opportunities to engage on this topic? Again, sorry, we should have updated the poll question. Ignore climate change, read Regulation 28 and infrastructure. It is very useful if we can get as many responses to this online poll as possible, please. Not everybody has responded yet, so if you could just, thank you. I see one more response has come through. The more the merrier in this instance. Okay, and while the last few of you complete the poll, just on behalf of Atleha-edu and our funders, the Assisa Foundation and 91, thank you very much for joining us today. We trust that you've benefited from the opportunity to unpack Regulation 28 and the proposed changes, as well as the different types of infrastructure types, especially given the fact that Reg 28 now enables retirement funds in South Africa to invest up to 45% of their investment portfolio into infrastructure assets. Thank you so much to everyone who has responded on the polling question. So I'm going to end the poll. I'm going to share the results very briefly. It looks like there has been improvement. And yeah, hopefully as we do more of these types of sessions, you'll feel more confident on a number of topics. So with that, I think we're well over our allocated 1.5 hours. Thank you to you all for joining. And these, as I mentioned, are being recorded. What we'll do is Safaku will send the recording both to yourselves as attendees, but also via our WhatsApp groups and via the links that we can share. And we do hope that you can join us for our next session, which will be looking at impact investing, which will have a little bit of a link to infrastructure, because infrastructure can be seen as an impact investment asset class. And Safaku will be presenting on impact investing in 2 weeks' time. So with that, let me thank you for your time, and we look forward to you joining at our next session. All the best, and have a good 2 weeks until we see one another again.
Thank you.
All the very best. Bye-bye.